You found a promising company, but its financial statement is a confusing wall of numbers. You see net income, EBITDA, and free cash flow, all telling you if the company is making money, but the figures can be massively different. Which one tells the real story? This video breaks it all down. We'll demystify these terms so you can look at any financial statement with confidence, and you'll learn which metric legendary investors use to gauge a company's true financial health. Section 1, the bottom line, understanding net income. Let's start with net income, the bottom line on the income statement. It's the profit left after every single expense is paid, like your take-home pay after all deductions. You take a company's revenue and subtract everything: production costs, salaries, interest, and taxes. It's the official score of profitability. But there's a catch. Net income includes non-cash expenses like depreciation. If a company buys a $50,000 truck, it doesn't record a single expense. Instead, accounting rules might spread it out as a $10,000 depreciation expense for 5 years. This expense reduces net income, but no cash actually leaves the bank, making the company seem less profitable from a cash perspective. Section 2, the analyst's favorite, decoding EBITDA. EBITDA, or earnings before interest, taxes, depreciation, and amortization, is what many analysts prefer. You find it by taking net income and adding those 4 costs back in. The goal is to see a business's core operational profit separate from its financing decisions, tax policies, or non-cash accounting. Adding back interest and taxes helps you compare different companies on a more level playing field. Adding back depreciation and amortization D&A aims to show cash-generating power. But EBITDA has a dark side. As Warren Buffett noted, the costs that depreciation represents, like replacing equipment, are very real. Ignoring them can paint a dangerously optimistic picture of a company's health. Section 3, the real story, free cash flow. This brings us to what many consider the king of metrics, free cash flow, or FCF. If net income is the official story and EBITDA is the operational one, free cash flow is the cash story. Cash is what keeps a business alive. FCF is the cash a company generates after paying for operations and the investments needed to maintain and grow itself, known as capital expenditures, CapEx. It's the leftover cash the company is free to use for paying dividends, buying back stock, or paying down debt. A company can show positive net income and EBITDA, but have negative free cash flow. FCF is hard to fake and reveals true financial strength. This is why Warren Buffett focuses on it. He wants to know how much real cash is left over, as that is what creates long-term value for investors. So let's recap. Net income is the official profit, but can be skewed by accounting. EBITDA shows core operational performance, but ignores real-world costs. Free cash flow tells the cash truth. A pro investor looks at all 3. But if you had to pick one, make it free cash flow. It's the hardest to fake and answers the key question: is the business generating more cash than it burns? Understanding this is a huge leap forward. If this helped you, hit subscribe and let me know in the comments what you want to see explained next.